Welcome to This Explainer. Today, we're diving straight into the 2026 housing market, and let's be honest, if you've even casually glanced at real estate or tried to buy a home recently, you know exactly how high the tensions are running right now. We're going to impartially unpack this whole situation by placing the current political actions happening in Washington side by side with the hard economic data from Wall Street. We want to figure out what's literally driving American real estate right now. So let's tackle the big central question that is just absolutely dominating the headlines today. Are large institutions really the real estate boogeyman they're made out to be? We're going to explore whether policing institutional investors is the magic silver bullet for affordability or, if the much harder, grittier task of actually building new homes is the true answer to saving the American dream. Okay, here's our quick roadmap for today. We'll start with the 2026 housing market outlook, then look at the push against Wall Street, see what the data actually says, identify the real housing supply problem, and finish up with the build-to-rent boom. Let's get to it. Section 1. The 2026 Housing Market Outlook. Let's start by zooming out for a macro overview of where things currently stand. Well, according to a recent outlook from Ameriprise Financial, we're actually seeing a very real glimmer of hope for buyers right now. The average rate for a 30-year fixed mortgage recently dipped below 6.0%. Now, after years of these painful, relentless rate hikes that basically locked millions of people out of the market and totally froze existing home sales, this is huge. It's a massive psychological and financial milestone. We've hit a 3.5-year low, finally bringing those punishing borrowing costs back down to earth. To put that into perspective, let's look at what that actually means for your wallet in the real world. If you're looking to buy a $400,000 home with a 20% down payment, dropping from a 7% rate down to 6% means you're keeping about $375 in your pocket every single month. That's a 15% drop in your monthly mortgage payment. Over the lifespan of a 30-year loan, we are talking about saving well over $100,000 in interest. So this drop is definitely giving prospective buyers some much-needed breathing room. But we have to keep in mind, the actual price tags on the homes themselves are still incredibly high, so overall affordability still remarkably tight across the board. Moving on to Section 2, the push against Wall Street. Let's look at exactly how politicians are trying to solve this affordability crunch. Back in January 2026, the White House rolled out an executive order with a very blunt title: Stopping Wall Street from Competing with Main Street Homebuyers. The administration's core argument here is that large Wall Street investors have spent the last decade systematically snapping up single-family homes. The idea is that these massive funds are rolling into town, outbidding hardworking families with all-cash offers, and effectively turning traditional owner-occupied neighborhoods into giant corporate rental portfolios. And we're seeing this momentum materialize through a two-pronged legislative approach. On one side, you've got the White House executive order, aiming to heavily restrict the corporate footprint by capping investors at a suggested maximum of just 100 single-family units. Meanwhile, the Senate is pushing the 21st Century Road to Housing Act. This one is way more aggressive. It directly targets large entities that control 350 or more single-family homes, basically aiming to completely block them from buying any more housing unless they qualify for a highly specific exemption. So, what happens if a Wall Street firm breaks these proposed Senate rules? Well, the penalties are meant to be totally crippling. We're talking up to a $1 million fine per violation, or 3 times the purchase price of the property, whichever number is bigger. Plus, even if an investor somehow gets a permitted exemption to buy a house, they're hit with a mandatory disposal requirement. They legally have to sell the home back to a regular individual buyer within 7 years. And on top of that, current renters actually get a right of first refusal, meaning they get a 30-day first look period to buy the home themselves before it even hits the open market. All right, Section 3, what the data actually says. It's time to measure these intense political claims against the hard economic reality. Now, this is where the narrative and the reality take totally different paths. Despite all the terrifying headlines about corporate takeovers of suburban America, the data from Bank of America and UBS paints a completely different picture. Are you ready for this? Large institutional investors actually own roughly 0.35% of all single-family homes in the U.S. Less than 0.5%. Even if we only look at single-family rentals, these mega corporations still just make up about 3% of the total pool. So the vast, overwhelming majority of rental properties in America, they aren't owned by Wall Street. They're owned by individual mom-and-pop landlords. Actually, scratch the idea that they're taking over, because the trend is moving in the exact opposite direction. Blackstone, who is literally one of the largest institutional real estate players on the planet, reports that their single-family home purchases are down over 90% since 2022. Today,
They own 22% fewer homes than they did 8 years ago. Basically, thanks to higher interest rates, the math just doesn't work out for these funds anymore. They're net sellers right now. They are actively retreating from the single-family space, not hoarding it.
And there's another fascinating piece to this puzzle from the American Action Forum. It's about the types of homes these companies actually buy. Data shows institutions drop an average of $39,000 per home on upfront renovations. Compare that to your typical homeowner who only spends about $6,300 in their first year. Why the massive gap? Because these institutions are purposely buying distressed, dilapidated houses that regular buyers simply can't get a traditional mortgage for. By pumping capital into these unlivable properties, the data shows they're actually expanding the supply of quality rentals, effectively recycling unusable homes back into the market. So, Section 4, the real housing supply problem. If Wall Street isn't holding the housing market hostage, what is the actual problem? According to both the American Action Forum and UBS, the real culprit is a severe systemic lack of housing supply. We are simply not building enough homes for our growing population, and builders are feeling the squeeze from literally every direction. You've got skyrocketing raw construction costs, which are being heavily amplified by tariffs on essential materials. Think Canadian softwood lumber and Mexican gypsum. Throw in a massive nationwide shortage of skilled construction labor, and top it all off with highly restrictive state and local zoning laws. It's a perfect storm that makes building high-density new housing incredibly difficult, expensive, or straight-up illegal in the areas where we need it most.
Which brings us to Section 5, the build-to-rent boom. Let's synthesize all this and see how the market is pivoting.
So how do investors balance this intense political heat to stay away from existing homes with the undeniable economic demand for new housing? Well, the industry found its answer in the build-to-rent, or BTR model. Remember those legal exceptions for new construction in both the White House and Senate plans? That was the loophole. Instead of fighting regular families over existing homes, institutions are now funding and developing brand new housing specifically designed to be long-term rentals. It's a real game changer because it adds net new physical supply to the market. It addresses the core shortage without triggering the political outrage of buying up existing neighborhoods. And the National Law Review outlines exactly how Wall Street is executing this new playbook. Step 1, institutional investors are literally building their own dedicated home-building subsidiaries from the ground up. Step 2, they're partnering with established local residential developers who already know the painful ins and outs of local zoning and permitting. And Step 3, they are deploying billions of dollars to finance massive, completely new, master-planned built-to-rent communities. This strategy hits two birds with one stone. It secures their long-term investment returns while completely aligning with the bipartisan demand for actual brand-new housing supply. So, as we wrap up, considering the strict new policies taking shape in D.C. and the clear economic reality of our massive supply shortage, I want to leave you with a final thought. Will policing a fraction of a percent of corporate investors actually move the needle for everyday homebuyers? Or is physically building our way out of this historic shortage the only real path back to the American dream? Thank you so much for joining me for this explainer. Keep asking the hard questions, and we'll see you next time.